terms of investing, I mean, the major change that's taken place, which kind of hit me with a hammer in the early March, was for the first time, we are going to be looking at companies that we have not met face to face. And this is a very, very personal type business. This is not like you're in the stock market where you buy and sell stocks and change your mind. Once you've made an investment in a venture capital company, a young company, you're a partner virtually. So I looked at the future and said, we're going to become partners of companies in terms of new investments that we will not have met the company face to face. We will not kick the tires and been to visit their facility. And we're going to have to depend to a much greater extent on the kind of due diligence work we have. And that depends on our being able to find other people wherever they may be located that will be able to give us some credibility about the company or the product. And I would say it's going to put a greater emphasis on the kinds of people we'll be backing, how much their team has worked together before, how they've melded, what their backgrounds have been. And so there's going to be a different depth. And at some point, whether it's going to be in June or July or August or next fall, we're actually going to meet them for the first time. So I think that's going to be harder. On the other hand, there's a lot of money in the venture capital pools, and investing is not stopping. I mean, if you read the sources of venture capital information, you'll see that every week there are new deals being done. I closed the deal just this week in my fifth investment in the podcast area, and I virtually don't know the founders.
So that brings up a good question of what kind of deals are you doing in terms of what's different? Like you mentioned things like if the founders have worked together before, that becomes maybe more important. I'm assuming maybe their balance sheet or their revenue model or how they're structuring might become more important since you can't meet them face to face. How are the type of deals that you're buying now different?
Well, honestly, I don't think they're that much different. I think that the way you make the investment. Now, first of all, if we have the companies in our portfolio, I think there'll be a much greater emphasis on our existing portfolio companies because they're going to need follow-on capital and be a lot easier to make those kind of investments because you'll have had some empirical data to deal with. They're probably further advanced their growth, and you have met them and you have experienced and you know something about them. So if they come back to market and they need, let's call it an A round or a B round, you can certainly feel more comfortable in making the investment with less concern of not having had that personal interaction. But I think that in terms of the kinds of deals, I don't see any change. We've been very active in the last year in insurance technology companies. We've been active in the real estate technology area, which is kind of a new area that had been developing over the last year or two. And I think those are areas that particularly insurance in general, health insurance as well as life insurance is going to do very well in this time. This world of financing. I've spent a lot of time in podcasting. I started 2 years ago and have been gradually meeting various companies, and we have a full portfolio in that area today. And podcasting is doing quite well in spite of the fact that people aren't traveling as much. They are still listening in addition to viewing.
No doubt. What about valuations? When you talked about having to put more funding into companies or you're looking for opportunities, what have you noticed in terms of those valuations?
Well, entrepreneurs have a strange, you can understand it, but it's strange in this environment. The market, let's pick a number, and it's hard to pick a number because every day